Hello and welcome back. I'm your host, Dr. B. Today we're going to be talking about liabilities, current installment notes, and contingencies. Liabilities. We've already discussed a lot about liabilities in previous chapters. We talked about current liabilities, long-term liabilities, accounts payables, accruals, and we're going to talk more in depth about liabilities. Okay. So, current liabilities. Current liabilities are debts that the company owes to someone else short term. Short term. Remember, the word short term means less than 1 year. Long term is greater than 1 year. Current liabilities are short term debts. An example of that would be I received my electric bill. I haven't yet paid it. I put it into accounts payable. Accounts payable is an example of a current liability. Other current liabilities include things like current notes payable. Current notes payable. That's the current portion of a long-term debt. Current notes payable. It is a short-term loan. That is a current liability. Accounts payable, as you know, is when the company receives a bill for a service or merchandise that we have purchased but have not yet paid it. That creates what we call an accounts payable. Accruals are the guarantee to pay an accrual. I am accruing the expense. I've incurred the expense. Now I am accruing the expense. It's accruals. We talked a lot about that over the past several weeks. Okay, let's talk about short-term notes payable. Short-term notes payable is a conversion. Okay, here's how it works. Let's say we had a bill that said, hey, pay us within 30 days. And we said, hey, you know what? I can't pay you in 30 days, but I can pay you within 90. So your supplier will then say, okay, we could do that, but we're going to have to charge you interest for the 90 days. And you think it's a good idea, so you go decide to do that. It creates what we call a short-term notes payable. And think of it like a short-term loan. It's a short-term loan is essentially what it is, but it's on your account, right? So to convert something from accounts payable to a notes payable, you debit accounts payable and you credit notes payable. What this does is it converts the debt from an account payable to a note payable. This is when the company says, I can't pay it in 30 days, but I can pay it in 90. So you negotiate with your supplier. Supplier agrees, says, I'll give you 90 days to pay, and I'll charge you an interest rate. In this case, it's 12%. So to convert it from accounts payable to notes payable, you debit accounts payable and credit notes payable. So in our example, it's $1,000 notes payable, 12% interest rate, and it's due within 90 days. Okay, so the total payment 90 days later is going to be $1,030. How did we get $30? Well, we know that the face value of the short-term notes payable was $1,000. The interest rate was 12%. So 1,000 times 12%, you take your 90 days divided by 360 to get the exact percentage per day. Okay, why 90 divided by 360 and not 365, you might be asking. In the United States, we have 360 banking days in a calendar year. 360 banking days in a calendar year. What that means is the bank is open 360 days out of the year. 5 banking holidays in a calendar year. That's why it's not 365. So 90 divided by 365, you get to $30. $30. 1,000 times 12% is 12 times 90 divided by 360 gets us to $30. Okay, so we debit notes payable, which is the face value of 1,000. We debit interest expense because we're paying interest on top of the notes payable. You got to make sure that it's always separated out, okay? The reason being is because we account for interest separately than the face value. So debit notes payable, debit interest expense, and credit cash. Remember, your debits always equal your credits. Good so far? Yes?
Yes, sir.
Great. Thank you, Mike. Appreciate it. Each note transaction affects a debtor and a creditor. We figured that part out, right? I mean, there's always going to be a borrower and a lender anytime we're talking about loans. Okay, here's a couple of examples. Company purchased merchandise on account. Company then can't pay that note on account, so they approach their lender and say, or they approach the creditor and say, hey, convert it to a notes payable. They agree, and then they, on top, in addition to the actual note payable, they have to pay interest. That's an example here. Well, you see the borrower and the creditor side of things. The borrower is the one who had their original accounts payable converted to a notes payable. On the creditor side, it's receivable, right? You got one that pays and one receives. The one that pays is the borrower. The one that receives is the creditor. It's a nice slide. The company may also borrow from a bank by issuing a note. It works the same exact way, right? If the company borrows money from a bank, that means they're receiving cash. And they're also creating a notes payable. In that case, you debit cash, credit notes payable. And of course, you want to include the details. In this case, our company is borrowing $4,000 for 90 days at 8%. Then, so obviously we need to pay them at the end of the 90 days. So at the end of the 90 days, we debit notes payable $4,000, we debit interest expense $80, and we credit cash. To figure out interest expense, you take the face value times the interest rate times 90 divided by 360, or in other words, the number of days divided by 360. It's always by 360. Remember, 360 banking days in a year. In some cases, we call this, the interest rate is called a discount note. Discount note. So here's the difference. You have interest and you have discount. Interest means that the company that's borrowing will pay back the face value plus interest. If the loan is what we call a discounted note, instead of receiving the face value, you'll receive a lesser amount. The lesser amount is the original face value minus the interest rate. So here's how that works. The loan was for $20,000. Instead of the bank giving us the $20,000, they gave us $19,500. Why did the bank do that? It's called a discount. Yep. So the way it works is on a $20,000 loan, the interest rate is 9% for 90 days. Same formula. So it's original face value times the 9% times 90 divided by 360 gets us to a discount rate of $50. Remember, instead of interest, it's discount. Okay, so therefore the bank gave us, where am I? Oh, So so the discount rate, the discount's $50. So instead of the um, instead of the 20,000, we got 19,550 based off of the formula, right? So we debit cash 19,550, debit interest expense 450, and credit notes payable 20,000. And then of course we're going to pay it back, but we pay it back on the full value. Debit notes payable, credit cash. That's when we're paying it back. There's also this thing called an installment note. Installment note is a debt that requires a borrower to make equal periodic payments over the term of the note. An example of an installment note is your mortgage. It's your car loan payment. An installment note. The word installment means the same periodic payments over the life of the loan. So, for example, you have a car loan. You pay $400 a month for your car. It's $400 a month for that 5 years or for however long it is, right? So you're 360 months or whatever. That's called an installment note. Same amount over each month over the life of the loan. Let's talk about other liabilities. Payroll liabilities. As you know, if you have an employee, you have to pay your employee, right? You pay your employee every 2 weeks or whatever, or every week or every other week. It's typically every other week. Payroll is a liability. The employee punches in using the time clock or whatever. They accrue their hours over time. At the end of the 2 weeks, we go to payroll. Payroll goes, okay, employee worked X number of hours at times their hourly rate. That's the payroll amount. That's the gross. But then the company also has these other things called taxes, right? So does the employee. The company takes out the taxes for the employee, and the company also has their own taxes that they have to pay. Unemployment tax, federal income tax, state income tax, local tax, unemployment tax, all that good stuff. So what the company does is they withhold the taxes on behalf of the employee and then remit or pay those taxes to the related agencies. And they do that every 2 weeks. So remember, liability is any time that the company owes someone else. The same goes for payroll. And also sales tax and other types of taxes, right? Salary is referred for management. Salary means they get the same amount every year, right? And they divide that monthly or semi-monthly, whatever. And then, so the salary is usually for somebody who's on a salary or a fixed wage. And then wages are referred to hourly employees. It's just terminology, yeah? And of course, you know, employees can also get bonuses, commissions, profit sharing, all that fun stuff. Cost of living increases. Wages are governed by the Fair Labor Standards Act, also known as the Minimum Federal Wage and Hour Law. This law also says every hour worked over 40 hours per week, employees are eligible for overtime. Hourly employees, that is. And it's at a rate of time and a half. Time and a half means they get their hourly rate plus half for each hour worked over 40 hours. Unless it's an exempt employee. Exempt employees are typically salary employees. Salary employees are exempt from overtime. Typically. Not always, but most of the time. An example of an employee's earnings. Employee works for 40 hours at $34 per hour. their base rate is $1,360 per week, 40 hours in a week, right? Then the employee worked a few hours overtime. In this case, the employee worked for a total of 42 hours during the week. 40 hours at the base rate, 40 times $34 per hour is $1,360. The employee worked 2 hours overtime. That's time and a half. So $34 per hour times 1.5 times the 2 hours is $102 in overtime pay. So the total earnings is the regular rate plus overtime, $1,360 plus a 102. Gets you to the total earnings of $1,462 for this employee. Make sense so far? Everyone's good? I know we're going through this quickly, but it's relatively straightforward, yeah? David, you good?
Yeah, it makes sense.
Awesome. Great. Thank you. Deductions. Now, unfortunately, we have these things called taxes we got to pay. I'm not a big fan of taxes, if you couldn't tell. Okay, so before taxes, we have what's called gross pay. The word gross pay means before taxes and before overtime. That's like your base pay is also what it's called. Base pay or gross pay. Yeah, it's before any deductions. Then you have deductions. Deductions include things like taxes, child, what do you call the thing for the kids? You got taxes, insurance, child care, pension deductions, retirement, 401k. All these things come out of your paycheck. Okay? So you got gross pay minus your taxes, minus your insurance, minus your other benefits, right? Gets you to your net pay. These are very typical things. Net pay is what you actually get in your bank account, yeah? Income taxes are declared by employees using this thing called a W-4 form. W-4 goes to the IRS, tells the IRS how much to withhold from the employee. You're the one that fills that out, the W-4. When you first get hired, you fill out W-4. Tells you how many you say how many dependents you have. It tells you how much to be withheld from your paycheck every week. Or, using that factor. This is an example of a W-4 form. It's got your name on it, number of allowances. W-4 indicates marital status, withholdings, any other deductions you want, things like that. Each allowance reduces the federal income tax withheld by an employee. Don't get caught up in that nonsense, okay? I don't want you guys playing around with this W-4 stuff and keep changing your allowances. I know some of you are doing that. I used to do that too, okay? The IRS finds out, you will end up paying a penalty. So don't be playing that game. Don't play that numbers game with the IRS, all right? You don't want the IRS after you. I would rather have the mob after me than the IRS. The IRS is way worse than the mob, let me tell you. Okay. Employers are required to pay federal insurance contributions. These are Social Security, Medicare, and unemployment benefits. Employers and employers are required to pay into Social Security. 20% standard deduction. It is right now, yeah, until they change that. Social Security, both employers and employees are required to pay 6% on all earnings into Social Security. And employers and employees are also required to pay Medicare, 1.5% on all earnings. Basically, what this is supposed to do is that when you reach retirement and you're in retirement, you collect Social Security check every month from the government. Hopefully it's still around, right? And then we also have this thing called Medicare. So for older folks who It's basically government medical insurance is what Medicare is. And it helps older folks to pay their medical expenses. And we all pay into that. So everyone who works is paying into Social Security and Medicare. And also, so are your employers. They pay the same amount that you pay. So this is just an example of how those calculations come out. So you got your total earnings times that percentage, total earnings times that percentage. You just simply add those two together. Employees may choose to have additional deductions such as retirement savings, contributable, charitable contributions, life insurance, child support comes out of there. The list goes on and on. Yep. And there could be like other benefits that your employer helps you with, but doesn't always cover the whole cost, like dental insurance, things like that. Computing employee net pay. So how do we compute net pay? Net pay is also called take-home pay. It's your gross earnings minus all your deductions. So gross earnings minus Social Security tax, Medicare, federal income, state income, retirement, any type of charities, any other deductions. Total gross earnings minus total deductions equals net pay. Payroll taxes. Employers are required to pay unemployment taxes for both federal and state, in addition to Social Security and Medicare. So the employer has the additional, right? The employer always has to pay a little bit more than the employee does. Recording payroll is typically done with a special journal entry at the end of each accounting period. You debit your payroll expenses and you credit your payroll liabilities. So here's what that looks like. You debit your payroll expenses, which your salaries and your whatevers, and then you credit all of your liabilities, your taxes payable, your salaries payable, so forth and so on. And that's what that journal entry looks like. It's nice and long. Special journal entry. Employers must match employee Social Security and Medicare taxes. In addition, they must also pay unemployment taxes. So the employer pays Social Security tax, Medicare tax, state and federal unemployment tax. So if you ever become unemployed for whatever reason and you're eligible to collect unemployment, that's where that money comes from. It comes from your employers. They have paid into this fund. And that fund then goes to you when you need it. That's what it's there for, yeah? And this is a journal entry for payroll taxes. Paying payroll. Payroll is paid by checks or electronic deposit. For those of you who do not have electronic deposit, I highly recommend you get it because you typically get that much faster than you would by getting your check in the mail. Yeah. So strongly recommend it. And remember, you can never run from the tax man or from the child stuff. They'll always come to get you. So yeah, EFT is the best way to do it. Internal controls for payables. The person writing the check should never be the ones cashing them. Fringe benefits, these include things like vacation time, medical, and retirement benefits. That we call those fringe benefits. Vacation pay is something that gets accrued over time, like an hour per pay period, a couple hours per pay period. It accrues over time. This is a journal entry for that. If you have vacation, I highly recommend you take it. Please take it. Even during these times, we all need a break once in a while. Pensions are paid by some employers over time when you retire. It's kind of nice because it pays out over the life of the employee. Yeah. Defined contribution plan, very similar to a pension. It's like a 401k. 401k is a retirement defined contribution plan. Please make sure you have retirement. Please make sure you have retirement. You don't want to be retirement age and not have anything to live off of. Most cases, the employer will match employee contributions, sometimes, up to a certain amount, usually. Defined benefit plans, like I said, they're very similar to 401ks. It's based off of a percentage, years worked, dollar amount saved, that type of stuff. And it's usually very explicit. Everything's very well mentioned. Other types of benefits employees get: dental, eye, medical, life, and tuition assistance, tax services, legal services, sometimes. Not all employers have the same benefits. Post-retirement tax benefits, some employers will even go beyond just simple retirement, so they'll help you out with other stuff. Installment notes is a long-term liability that goes against the deductions. An example of an installment note is like a mortgage. We talked about that earlier. When an installment's issued, you debit cash, credit notes payable. Periodic payments, you pay regularly over time, right? A couple of examples. Contingent liabilities, these are liabilities that depend on a couple of factors. One is the likelihood of it occurring, the other one is the measurement. An example of this would be like insurance paying out based off of the likelihood of an accident happening, right? What's the difference between probable and estimable? Probable means what is the probability of it happening, and estimable is what is the estimation of something of the cost for something happening. Probable is not estimable. Something that is reasonably possible, we call that probable. Something that is remote is it probably won't happen, but it might. Right? Reporting liabilities includes reports to accounts payable, accruals, notes payable, current portion of long-term debt, and any other debts due within 1 year. And you've all seen the balance sheet 1,000 times by now, right? Analysis of this. A couple of ratios. Working capital, quick current ratio, and quick ratio. These are good ratios to know, okay? Working capital. Working capital is you take your current assets minus current liabilities. Current assets minus current liabilities is working capital. Working capital is used by companies to reinvest into the company. Current ratio. Current ratio, you take your current assets divided by current liabilities. The current ratio tells us the company's ability to pay all of its current debt. That's the idea behind it anyway. And the quick ratio. Quick ratio, it measures the instant ability to pay its current debt. We take that by taking quick assets divided by current liabilities. Quick assets are things that can be quickly converted into cash. This would include cash and cash equivalents. It does not include inventory. And that is it. Are there any comments, questions, or concerns I can help to answer for you about liabilities? We're good? Okay, we went a few minutes over. Now, as a reminder, what do we have for homework? We have the Chapter 9 homework assignment through Cengage. And we have the Chapter 10 quiz through Blackboard. Remember, only access everything through Blackboard. Try not to ever access anything outside of Blackboard. Just go right into the week, click on everything, okay? If you have if you're still having any trouble with your book, you need to let me know immediately so I can get that resolved.
I have a question.
Go ahead, Richard.
I just wanted to know, is 20% a standard deduction? Because as a business owner, I'm required to at least save 20% of my profits for taxes. So I just wanted to know if that is a standard.
It's a good rule of thumb, yeah. Yeah, that's a good rule of thumb. For a business, it's usually 20%, and for an individual, I usually factor about 30%. Yeah. Good question. Absolutely.
Thanks.
Yeah, my pleasure. Any other comments, questions, concerns? Anything at all? Anything at all. Could be about anything.
So, what are the advantages between paying taxes quarterly and paying it annually?
Yeah, so quarterly, it helps you to better manage your cash flow, especially with a business or an individual. Like, for example, every year I always owe the IRS money. Uncle Sam hates me, I think. But every year I always owe the government money. And so what I do is I pay quarterly estimated tax payments. The reason why I do that is there's two reasons. One is it helps me to budget my cash flow every quarter. And the other reason is it will help you to avoid paying any penalties to the IRS. Okay, there's a couple of rules that the IRS has. If you miss quarterly estimated payments, I mean, you can still pay it annually as long as it's before the end of the year. Okay, this will help you to avoid paying penalties to the IRS in addition to the tax. So quarterly is much better. Good question.
Awesome.
Yeah. Anything else? Any other comments, questions, concerns? Okay, my friends. So here's the deal. Chapter 9 homework, Chapter 10 quiz. Make sure they're done by Sunday night, please. Please, please, please. Very important that you're on time, especially from here on out. We only got 4 weeks left. If you think of anything else, you need any help, you have questions, you let me know. Email me, call me, set up office hours with me, whatever it is. I'm here for you, okay? So, and please, if you can, please take the mid-semester survey found in week 4, back in module 2, just below the midterm. It's worth an extra 5 bonus points, five free points. All you got to do is answer the 5 questions. Open-ended questions. I won't see who did it. It's very anonymous, okay? And remember, it helps me as a professor, and it helps you as a student. And it's a good thing. So thank you all so very much for your time today. I really appreciate it. If you ever need anything, you ever have any questions, you just let me know. I'm here for you. Thank you again so much. Have a great rest of your day. Stay safe. Wash your hands. Take care. Thank you all so much.